Hello, this is Jonathan Nichols with the Strategic Multifamily Investing Podcast, and I have with me Julie Peterson. Hey, Julie. She
Hi,
is
good morning.
definitely someone that you need to have on your team. If you do not have a mortgage person as yet, you're looking for someone. You've been told that you need to have a vendor that's into mortgages, et cetera. You need to call Julie. We'll talk a little bit more about her in the first place, but I first want to gush over her and be a fanboy, as some people would say. But she truly has been, a shining star on the team that we're putting together at Redwood LLC, and has provided very deep knowledge in things that we were about to get into. She helped us to say, I don't think you want that, Jonathan, and and provided a bright, shining light. And if nothing else, but to have, a very positive influence on your team. I think when you're creating your team or thinking about creating a team, you need to figure out the type of people that you want to have with you on the journey. Because for a lot of these properties that we're talking about potentially purchasing, you're going to be with these people for 5-10 years. And so you want to make sure that the relationships are right. We were just having a pre-conversation about that. But I digress. I want to talk to Julie a little bit more. Julie, can you introduce yourself, kind of how you got in the industry and how you got to Old Capital?
Sure. Anne Peterson with Old Capital Lending. We are a premier provider of debt for, mostly we do multifamily, and we do storage, mobile home parks, industrial, storage, retail. I think I said at the same time, but we do a lot of focus on multifamily. Especially we got started 35 years ago. Paul Peebles started it, and we've done 5,700 loans. We do $1 billion a year, and it's been a great time up until just a couple months ago. But I've been in real estate. I bought my first house 30 years ago, and I've been in real estate. Been a landlord for 20 years. Had one eviction. Have been in the Bay Area. I'm actually located in San Diego, but I had property in the Bay Area, tripled or doubled our money there, went to Chicago, went into negative AM there. Took me 11 years to get money out of that deal. I think I made $50,000 in appreciation, but great cash flow. Then brought that capital over to San Diego, and we've got 14% increases year over year in appreciation until a couple months ago. So, my interest is I'm an LP on quite a few deals, and on the sidelines, I'm not a syndicator. That is a goal of mine, to be a GP on a deal, but my interest is to sell my properties here in California so I can syndicate in other markets where, we're not making $2.49 a month. So I got to Old Capital several years ago, and, again, we've got 6 offices. I'm the only one outside of Texas, and I'm here to tell you that there is life outside of Texas when it comes to multifamily.
Right.
Great markets. We're looking at Phoenix, year over year, 8% rent increases. Utah's another great market. Boise has done some great things in the past. But we spend a lot of time over on the East Coast, the southern part, South Carolina, North Carolina, Savannah, Georgia, Birmingham, Alabama, Tampa, Florida, Jacksonville, Orlando, some great markets. And, up until COVID, we were all going, positively into the market, knowing that there was going to be a downturn at some point. But this is not a downturn. This was not an intentional financial downturn. It's rather a crisis, a health crisis that we're in right now. And we are severely being affected by it. From my standpoint, from a lender standpoint, things have come to a screeching halt in some markets in some ways. We've done a lot of interviewing of folks who've been in the market for 35 years or 37 years and have gone through different downturns. And they would tell you that they're taking their foot off the gas right now. It's just very difficult to get into a property that is, being managed correctly with, the unemployment and and having people not being able to be evicted and forbearance, and all of these things are contributing to an environment that it's difficult to say the
Okay.
least, right? It's uncertain.
You've got a lot for me to unpack here. And so I want to ask a couple things. Number one, let's give a shout out to the Old Capital podcast, right?
Great. Yes, we have, well, right now we have 65,000 downloads on Old Capital podcast right now. And you can find that on YouTube. You can go to our website, www.oldcapitalpodcast.com, and find Paul Peebles and Michael Becker are hosts for most of them, but I was on one just recently, so you can hear me speak with some guys that we closed a deal recently in New York, again, outside of Texas.
Right. Well, I highly recommend that podcast. I've found some great information. And again, Michael Becker is also very, very well received, if you will, in the industry. I want to back up a couple of things. You mentioned that you're an LP. We're talking to some people who maybe just getting started as well, and so I know we throw a lot of adjectives around. Let's kind of unpack some of that. What is an LP and their role?
So an LP is a limited partner. So on a deal, we have to feed the deal with not only our general partners or our managers of the deal. We need to feed, they're going to bring about 10%.
Okay.
But in a deal that has a 75% LTV, we're talking about the rest of the down payment. Okay. So you need 25%, right? So the GP, the general partners, the managing partners are going to be bringing in 10. So there's 15% that needs to be made up.
Right.
Those are the people that they're called limited partners, and they have limited exposure to making decisions. So when you are a limited partner, you are going to be looking at the deal, in which, Red Boot is going to be looking for limited partners.
Yeah.
And you're going to be presented with the opportunity. You're going to know all about the deal. So you definitely are investing in it. But in terms of making day-to-day decisions, that's not where the LP is used. These are opportunities that you're going to make a cash-on-cash return,
right,
on a monthly, quarterly, yearly basis, as opposed to the GP that is managing the deal. They find the deal, they work it, they work with the asset manager, they work with a bunch of people to get the deal done on a daily and monthly basis.
Right.
So a lot of times as a limited partner, you'll be looking at deals where you'll be required, or the deal requires accredited investors, which are $100,000 investments at a time. So maybe you've got 500,000. You could put your 500,000 there. You could park it there. You could do it 100 here, 100 here, in different opportunities.
Right.
There are sophisticated investors who don't have the capital of 100,000, but maybe they're looking at 50,000. Now remember, and I'm sure you've gone over this with your client base before, but maybe not, that you have to have a relationship before being given the opportunity to invest. And so, we
just 1 second. We specifically have talked about Mauricio Roll, the attorney, syndication SEC attorney, in his 7-step process. And we actually use that. And if you're interested in potentially becoming, an investor with us, you can go to our website, Red Boot LLC. And in the top right-hand corner, it says invest with us. If you click there, you can fill out a quick questionnaire, and we can talk more about that. But that helps us to be able to establish a relationship. And you're correct. And before we can present you with any additional, properties or investment opportunities, we want to be able to understand you, and you to get to understand us and the people that are on our team. And again, Julie is on our team, and we're very happy to have her as a part of that. So you mentioned that the GPs are people who are very seasoned, and I know specifically we're looking in Phoenix as one of our areas, and we were able to partner with a very seasoned operator who's there, who has about 30 plus years of experience.
Right.
We very well could bring on to this show if he would allow us to kind of talk to him and figure out, how he got to be, where he is. But those are the kinds of people that will, from a red boot perspective, will be, helping us to manage these properties, because again, they've seen the up and down markets, they understand what's going on, and they can help us to navigate these waters. Again, building that team is really important. I'm sorry, I think I cut you off where you.
No, I would just elaborate on that from a finance side,
Sure.
Jonathan. That we as a lender are going to look for those relationships. Now, if you're new as a GP, maybe you don't have experience, but you're in this, you're learning, you're getting to know how to underwrite and all this. You found a deal, but you don't have this experience. You're going to be looking for that deal sponsor, right? And as a financing company, we're going to want to know who that is.
Right.
So we, as we're helping on that end. Jonathan, if you went to another area that you don't have a deal sponsor, a lot of times because I'm in the middle of these groups, I know the deal sponsor. So that's I bring that value to the team, right, so that we can help facilitate you closing that deal that you found. Maybe all we need is net worth, because we require net worth of the loan amount and 10% or 9 months, depending on who the lender is. If we're going with Fannie or Freddie, we're going to need liquidity. And so what happens is maybe you have 2 or 3 on your team, but your loan amount is excessive of what their net worth is. So I can help bring those folks on to the team.
And she has. So we had I think also, as a part of the GP, the general partnership, the management team, key person, KP is also another term that you may hear, is someone generally who has that liquidity, who has that experience to be able to help sign for the loan. And so we had brought that person already. And come to find out, Julie had already worked with him on another deal. But when it came to, the seasoned operator, we didn't have that. And Julie was able to, facilitate that introduction. Again, this is the reason why I say you need to have her on your team. Because those people who are able to perform again and again and again, generally their names continue to keep popping up, right? And these are the same people, and it becomes a smaller and smaller community as you're continuing to learn and grow. Even to the extent of some of the vendors, because again, Julie sees all of these people. And so our insurance persons, we receive contact and information from them. By having sometimes 1 or 2 people on your team who have the relationships to all of these other potential people, you really can put together a deal, if it's the right deal, pretty quickly. So, you've heard, if you find the deal, then the money will come. This is a part of that. If you find a deal, and you have someone like a Julie on your team, and you explain your underwriting, which we've done on several different deals. And, we've gone back and what ifs and what ifs and what ifs. Mm-hmm. And, if you're solid and you're upfront, you got your hands open in terms of being able to be transparent, then I think, people are willing to kind of join with you and put those things together. So that's great. Did I cut you off? I know you were.
No, I would just elaborate on that too,
Sure.
In saying, because we have closed so many deals, we have partners all over, especially in deep relationships. Yeah. In the Texas area, where we've been in that transaction 4 times in that building. We've been the lender. So it just makes sense that, we can find the buyers, we can find the sellers, that we're really working hand in hand. And, and I have said this from the very beginning, that you're looking at your market, and then you're looking for your team. and
Yeah.
you're looking for your investors. You have to have those first before you go find the property. Okay, that's really, really, really important. And know what your investors are looking for.
When you got it. And that's very interesting because sometimes I've received properties in other areas where I don't have a team yet.
Yeah.
And, sometimes it's, do I even go after this? Because now I have to build another team for that particular area because
Yeah.
certain operators want to stay in certain markets. So you aren't able to translate those over. You have to go and, kind of go back to the well and find those other people. So how, go ahead.
You and I talked about this earlier, in that you're going to be in business with your partners. It's not just a one and done. You're going to be managing this property. This is a business. This is not, we find the deal, we find money, and it's done.
Right.
We're in relationship for 10 years,
10
potentially,
years.
right? I mean,
That's correct.
so just to, be calling up people and say, hey, I need a deal sponsor. It's not like that. Now, maybe you've heard of some people doing that, and maybe that worked in the past, but it's volatile times right now, and that these deep relationships, whether it's with a lender or it's with your deal sponsor or it's your broker, for heaven's sakes, these are what are going to keep you in the momentum of being in a successful lane, if you will.
So I have a question that I think some of our listeners are screaming, Julie, I've got this potential deal in Mississippi. Let's say Mississippi.
Yes. I've heard of this.
Yeah, you've heard of this, right? Yeah. How do I go about finding deal sponsors in Mississippi? I mean, is it that I'm talking to you? I need to be on the phone having a conversation with these people. Where do I start? Where do I start to go find these people?
Yeah, that's a great question. And there are many ways to go about it. I always think about, like, who's in your network right now, reaching out to them and say, hey, do you know anybody that has done deals in Mississippi? No, I don't, but let me ask so-and-so. And then maybe it sprawls out to, let's say a mile. You're right here in the core. A mile out doesn't really get you somewhere. So then you go to your next level of folks that you're talking to, and maybe that's in a education program that you maybe post there. And then if that doesn't serve you well, then take it even further and go to Facebook or go to your RIA locations.
So you've got a couple things that pop in my head. I want to. So if you don't have an education, whatever, again, I'm going to plug Michael Blank. MichaelBlank.com, Deal Maker Mastermind. I think it's $49-$50 a month for you to be a part of that. And there's a Slack channel that comes along with that, where there's an abundance of people, and Julie's in there as well, very active, that you can post these kinds of questions to, as well as, if you have a deal, and you need to have that analyzed or whatever, you can find those kind of people. And then you mentioned not just Facebook. So yes. So here is a something that just popped in my mind. Even if you're not a part of any Facebook groups that have syndication as a part of them, let me pause and let me go over to LinkedIn because it's popping in my head right now.
Absolutely, yes.
LinkedIn has syndication groups, multifamily groups that are out there that you can go and post into and/or research and find people and talk to them so that you can begin to establish those, again, substantive relationships to be able to find a deal sponsor. But if you know none of that, think about taking $35, $5 a day for 7 days, because I think that's the lowest that you can create an ad for, and create an ad for a syndicator that is in that area. You can go and flip it on its head. Syndicators are generally, I don't know what the age range is, but you could do that. You can, whatever the demographics are, the psychographics, you should be able to create a Facebook ad for that and have them to be able to go to a landing page or to a form and say, hey, you're looking for deals that are in XYZ area. And then that way it's a pull. People are going to see the ad, they'll click on it, they'll fill it out. And you may find, a partner there who can help you do the syndication. you might just find other additional LPs, or you may have other people who are GPs, but may not necessarily be operators.
Yeah.
That would be another way for you to be able to find people and to begin to establish the relationship. You're not presenting the deal to them. Again, Mauricio Rold has some specific guidance based on SEC guidelines, I think, that he's interpreted. Again, I recommend going out and looking for his stuff. Rold, R-A-U-L-D, Mauricio Rold.
Yeah.
Please go and look at those things. So, but again, it's a way of being able to make initial contact to be able to develop a substantive relationship. Okay.
Yeah.
Sorry. Was there anything else? Another way that?
No, I think I found a lot of value in getting into the Facebook, like multifamily groups.
Okay.
So not only just the broad spectrum of, multifamily, but really drill down to certain groups in that area as well. I think there's a lot of power in that.
Yeah, there's another group, say for instance, I'm talking about Phoenix. There's meetup.com. Go to meetup.com and type in multifamily, because there may be multifamily meetups that you can attend. And even now in the COVID situation, you may not be able to go face to face. A lot of them are having virtual meetups where they can Zoom in, you can meet people, get involved. So there are multiple different ways that you can go and find other people who could potentially be GPs and LPs and things of that sort. And if you run across somebody who does not, again, have the personality or can't develop the relationship that you want that makes it flow, keep trying. Keep trying.
There's a lot of people out there.
Keep trying.
Lots and lots.
Keep trying. Keep trying. You'll ultimately find some people, and I'm a witness and a testament to that, because there were some people who necessarily didn't flow with me, and I didn't flow with them, and it's not wrong. It's just different. You know what I mean? Mm-hmm. It's almost like being back in elementary school and, trying to find that group of kids that you want to play with on the playground. You know what I mean?
And let's face it, again, if you're looking for that syndicator, you want to have a very good, close relationship. And these things do not just happen overnight.
Yeah.
This has to be developed over time. And you might have a deal and that looks exciting to them. But if you don't have a good, first time meeting or even third time, I would move on.
That's good. Thank you for that.
Too much to risk. Too much to risk.
I remember talking with someone at one time, and they had the money. They said, I've got X amount of money and but I want to have control, and I want to do this and I want to do that. And it was just like, we've just met. Hey, I want to, let's talk before,
before we go to get married. Yeah.
Yeah. And it was just not quite, at that time, it may not be that way in the future, but just at that time, it just wasn't right. I want to pivot the conversation a little bit, because you talked about COVID-19. You've been talking to a lot of operators. You just had someone close when we're recording this. We're in May of 2020. They closed in New York, which was initially an epicenter, and it was a multifamily deal. So there's a lot of stuff here.
I will tell you that we closed before COVID, and it was probably, 4 days before COVID. So, we were so lucky, Jonathan. It was the time where we had a Fannie loan. So Fannie loans take about 60 days for the committees to look at them and, shuffle over here and shuffle over there. And okay, it looks good. And you sign there. And it's not until like day 55 that you have a commitment from them. Oh. And the market can go like this, right? I mean, you don't know. Whereas with Freddie, exactly. You can, the day you sign on the loan, you lock that loan. Right. Different than Fannie. So this loan, had we been on as a Freddie, we probably saved 75 bips by waiting. Yeah, it ended up great, these guys.
That's really good.
Yeah. And they got more loan dollars, and they got a lower rate, and they were able to do a Fannie loan as opposed to a Freddie. And again, we can go into this another time
Sure.
where we talk about specifics of the different loans that are out there, but really, really great to have been able to close that before COVID. Since COVID, like I say, a lot of people have taken their foot off the gas.
Why? I mean, but generally you hear people say, when everybody is scared and running away, this is the time to run in and do deals. And you're saying people who've been around for 30 years or so in this business are saying, I'm taking my foot off the gas. Not that they're stopping the car and parking it, but I would think that this is where you put more, gas. Put your foot on the gas.
It would seem, and that's what we've heard in the past, and
Yeah.
I think that these guys are still considering things. Whether they're really are making sense is where, where the rubber hits the road, if you will. So on a finance side, what we are requiring from our syndicators or our GP is between 12 months and 18 months of reserves. That's principal and interest reserves. So that could be, $450,000 sitting on the sidelines.
What was it before COVID when everything was right with the world?
We didn't have that. You would just have, there was no requirement unless, people would decide how much for themselves. Maybe they did 9 months, maybe they did, 12 months. The ones that are not struggling right now had 12 to 18 months. But this money is held, that other money was their own money. This is no longer their own money. This is being held in an escrow account that is, they cannot utilize it until the government removes the conditions of COVID.
So if the property can no longer perform, is the government going to tap into that money to maybe make some of the principal and interest payments, or
potentially, but we're going to underwrite that as lenders. We're going to underwrite that so that, there's enough, when we're looking at the pro forma, that there's enough DSCR that will be able to have the ability to manage this property correctly.
DSCR is debt service
coverage ratio. Right.
So is
so you have to have a 1, if it's a 1.0, right, that is making the payment. So what we're asking for is 25% more to cover in case there was emergencies. So in markets where they were standard or top markets, we were at 1.0. I'm sorry, 1.20.
Right.
Now we have bumped that up to 1.25. Or if it was at 1.3, now we're at 1.35.
Okay.
So, we're putting these requirements in. We also have 1 year of taxes and insurance. And if you have underwritten taxes and insurance recently, if you haven't, you better make sure you have a couple sips of alcohol before you do that, because it is impacting your ability to buy properties. Okay.
Yes.
The expenses they're being impacted by these 2 line items. Okay. So we're requiring those 2 items, as well as reserves, which again, these were reserves that were just, hey, we're underwriting this from a lender. We're using 250 on Fannie and on Freddie, and 300 on Fannie. Now it is required. Now you have to come up with that.
Let me pause, because I know some people are like, huh?
Yeah.
Let me just go back and break down a little bit more. So on your exiting costs, your closing costs, you're talking about reserving 12 months of interest, 12 months of insurance. Now, in the pre-COVID era, how much insurance was generally reserved?
It would depend on how much was left from the other folks, so.
And then in terms of the taxes, it was, we were underwriting 12 months of taxes no matter what, pre-COVID. I know some people were doing about 6 months of COVID, pre-COVID, but now we're talking 12 months of insurance, 12 months of tax, 18 months of principal and interest. Those things have to be done. And in addition to that, we're talking about reserves. Now, if you're looking at a pro forma, there are two places where reserves exist. There's one that's above the line, that's for CapEx or capital expenditures. Capital expenditures are the fixes and things that you need to do to the property. That's above the line. And generally, well, there are definite rules of thumb for that one. Well, let me give you that rule of thumb. Generally, whatever the average rent is that you have, you take that per every property and multiply that every door, right? And then you add that. That is generally what you're going to set aside as a reserve account for capital expenditures, right? Things that need to be fixed. And then there is a below the line capital expenditure, right? Or below the line reserve. And that's the one. And you're saying that prior to COVID, for Fannie, that was $250 per door?
Well, that was just used for underwriting purposes. It was not a requirement. Where it was a requirement is when you got into the deal and, hey, you know, as a lender side, we said, okay, we see you have to repair or replace the roof. Mm-hmm. That's going to be put into below the line. We have to collect that. We're going to hold it. It's going to be put into the payment, right? And so at some point that has to be done. Right. Whereas above the line, these things just are, you know, the washer dryer went out, so we have to pay for that. So these are accidentals, if you will, as opposed to these are requirements. So. Right. And below the line used to be, you know, from a lender standpoint, these were optional, right? Until it got to the performance, that when we analyzed it from a lender side, what was required. And even in that, you know, people really should be, you know, on these older properties. Mm-hmm. Now we're hearing more like 600.
Yes. And we in our underwriting, we're a little bit more conservative. We add a little bit more to that per door and set aside for the below the line reserves. Because again, for older properties, also just for any, you know, if you have, depending on the size of the property, like if you have on-site, you know, maintenance folks, you're going to need to have money set aside for them to be able to do their job, especially if it's an aging property or something like that. Yeah. And you know, not setting that money aside is really going to hurt you. Now, with that, you know, you actually wind up with a lot of reserves that then could, you know, lower what you can offer on a property because you're setting aside so much money for just. So,
and taking it a step further, really, then you're talking about returns to your investors. So that's where this really is impactful because obviously we need our LPs to feed this. And if LPs are saying, hey, I want to get 8% day one, we just can't return those right now. You know, we're seeing many of the folks that we're working with are saying, you know, flat rents or even declining rental income for at least 2 years. I even have heard 3 years.
Flat rents. Okay. So generally, when you're underwriting, again, if you don't, you know, understand how to underwrite and need a tool, again, michaelblank.com, syndicated deal analyzer, we call it the SDA. You should get it. And so in the SDA, you are able to model increases in both expenses and in rents. And you can do that per year over time. And so generally there is a default amount that's been set in there for both expenses and income over time. And that's basically set for markets that are, say, performing, like we talked about Phoenix here, you know, was, you know, 8 to 14%, you know, year over year.
Year over year. Crazy.
Yeah. And now that's way high. I would not say ever to model that at default. But now what we're saying is that you can expect your income, your rents not to increase for at least the next 2 years, quite possibly the next 3 years. Did I hear that correctly?
Yeah, absolutely.
Mm.
And the thing is now we're asking for those reserves. So it's really incredible when we do go ahead and there's two ways that this could go. You could use those reserves for your CapEx expenses. So
Right.
maybe you're looking at this property and saying, hey, this is a great value add deal,
Yeah.
meaning maybe you're going to reposition it.
Yeah.
You can use those reserves
That's the
to
above the
then
line.
start it.
Right.
Yeah. Um, or you can return that to your investors. And the returns then, we're seeing 8, 9, 9.5 on, day or year 2, maybe year 3, depending on how long we keep those reserves there. We need at least 2 quarters after we see the government lift it, and
Right.
we need to see that DSCR, that debt service coverage ratio, remains the same at 1.25 if you're in those certain markets, that remains correct for 90 days.
Wow.
So there's a lot of things, a lot of working pieces. So we asked these operators recently in a webinar, and we said, okay, so 200 unit building, distressed asset, but still 90% occupancy.
Right.
In the Dallas metro area, how would you finance this? And each one said bank financing. And why? No one does bank financing. You don't want bank financing when you're a big operator. You don't want to have somebody use your balance sheet, right? You want to have capital. You don't have any restraints, which is what a bank will do as a recourse loan. And we can go into that now or later. But to keep the flow of information going,
Sure.
they would choose a bank loan over a non-recourse that would do all these requirements with all of the reserve requirements, because you're asking your investor pool to bring in this, and they're not going to get the returns that they would had they not been asked to do that.
So
So
let me make sure I got that. So we're saying,
yeah,
Fannie Freddie would be considered government financing, just so everybody understands. So yeah, while Old Capital would be, say, your mortgage company that you're working with, they can do, Fannie Freddie, which is considered government. Now, what we're talking about when we talk about bank, we're talking about like generally a local bank, local to where oftentimes the property is, who may not have the restrictions for the reserves that we're talking about with Fannie Freddie. But
right.
you're giving up by going to a bank, a local bank, is the recourse part. And what does that mean? So
So yeah, you're signing that you will pay this loan regularly. And if you don't, Jonathan, we're coming after you. I always like to think about it like this. It's my hand going into your pocket and saying, let me have that wallet and I'll be back. And I'll be back. I've got this, your wallet, your money, your identity. I'm going to hold on to that,
right,
keep it hostage until we get all my money paid back, or the term of the loan,
right,
which is holding up your assets. You are holding your hostage, your balance sheet. So you're restricting your capability to purchase others. Well, you when you buy a house, you can only get a loan for a certain amount
right,
dependent on your income, right? So you might not be able to purchase another asset. And the whole point of this is to use other people's money, and if your money is stuck, you can't do that.
right. So if you are a beginner, and again, you need to consult your own tax attorney, your own attorney, whomever your financial advisors are.
Yeah.
But I would say, given this information, it seems like if you're just beginning, you probably want to go after a non-recourse loan rather than a recourse loan. A non-recourse loan, again, those reserves are there to help the government be able to take care of things barring anybody did anything negative, right? Intentional, to be able to repay back the loan and, deal with those things. It's kind of like,
Yeah.
so again, there is a way and a reason to use recourse loans, but again, those are seasoned operators, those people who have a track record, people who understand how to manage an asset and have teams of property managers and other people in place to be able to take that risk of going for a recourse loan. Am I getting that correct, Julie?
The recourse versus the non-recourse, people, I'll tell you this, that Fannie and Freddie never did play. They didn't participate in the syndication model 5 to 7 years ago.
Okay.
It's really only come in that they saw that this was an opportunity, that it wasn't just one guy who owned a bunch of oil and gas in Texas or 10 guys that were owning all of this. The model then became, hey, we can pool our money, right? And we're buying as syndicators, syndicating people's money, SEC regulations and all that played in. Up until 5 years ago. So they believe in this model. What has happened over the last couple of years is that a lot of people got into it. A lot of people that may have been on the fringe and putting these deals together and it wasn't as solid, that has caused, again, this is why we're pulling back a little bit and asking for these reserves, because of what the influx of all these new investors and such. So we just don't know what's going to happen over the next 3 to 5 months, maybe even 6 months, with these investors who came in over the last couple of years, had very skinny returns or capitalization or liquidity in the deal, right?
Right.
They were paying top dollar. They were in the best and final, and then they went to the next best and final, and then they asked for earnest money down hard, meaning you're losing 50,000, 100,000
on day
500,000, right? I mean, those days are over for now. Okay, the pricing based on the income, which we still see income being very strong, especially in the A's and B's, really good income. And that's off just a little bit. But remember, when we're going into these deals, these are businesses, and the way that they are appraised, how we find the value is how much the income is coming in and the NOI, right? That's telling us the value. It's not like single family, where we decide that the purple house is valued at 500,000 because it just sold 2 weeks ago. This is all about the income that is produced by this property. And if the income is going down because you're not able to get your tenants to pay, they're out of a job, they've been out for some time, they have their unemployment checks, and boy, are they big. But when is that going to stop? There's lots of philosophies and theories about that, and we can go down the road, and that would make this podcast
we'd be going forever.
Yeah. But if you think about it, we have these things in places, the stimulus and the extra money that's being presented to us in the unemployment checks. That is done to keep peace, and they're doing a really good job of keeping the peace, and so how long is it bad to keep the peace and then getting Freddie off the couch because he's now used to getting everything paid? When does it become detrimental? When does it become more of a problem for these operators? We just don't know, but I think we're going to see a big shift. I think you're going to see prices 20% off of what they were.
20%. That means things go on sale. Buy low, sell high. So then I think that's when, I guess, those operators who took their feet off the gas would potentially go put their foot back on the gas. So it may not be now, it may be in a couple months, say, 3, 4, 5 months from now. So then what that means is an opportunity, especially for those who are getting started, and especially for
Yeah.
those, say, like myself, who are looking at other markets, right?
Yeah.
That you're now contacting those seasoned operators who've taken their foot off the gas to develop those significant relationships now, so that
Absolutely.
when things start jumping to take a 20% dive, you have your hand on what's happening in that area and are able to pick up the phone and now present opportunities to
Yeah.
these people because you've established those relationships. So if you haven't established relationships before, now is the time. Establish
Absolutely.
those relationships, pick up the phone, make those phone calls, get the no's, get the rejections, get the who are yous, all of that kind of good stuff. Again, shout out to Michael Blank. There are ways that you can present yourself in such a way so that people will see what you bring to the table and that value add. I mean, for some of the operators, they're so, they may be at the point where they're kind of, hey, I'm operating and, I really don't look at properties anymore. And they may be looking for someone like yourself,
Yeah.
to bring them opportunities, to bring them deals that are, conservatively underwritten, that are, have solutions and things for them to be able to take a look at, and for them to be able to choose yes, no. You never know, something may come up where they say, I like that. That's good. You underwrite that well. Let's potentially take, let's move forward with this one.
Yeah.
So yeah, I'm not discouraged, but I'm encouraged, if you will, with this, as a person who, is starting an organization and building a team. We haven't gotten our first deal yet, but we will. And with that, there are things that we can do now that puts us into the game, just like all the other big players right now. So listen, we have spent time, and you and I know we can continue to keep going. And there are
Good.
at least 2 podcast follow-ups that we need to do. And
Yeah.
I'm pretty sure I'd love to schedule those. But listen, Julie, I want to say thank you so much for coming on our podcast and giving our listeners such great value-add information. How can people get in contact with you?
I am readily available, whether it's email jpeterson, Peterson, at oldcapitallending.com, or office, which rings my cell, 972-833-2774. I am happy to spend time with you. Do the due diligence now. Figure out where you need to go, where you're going, where we can get some help for you, whether it's a deal sponsor, get some LPs, or insurance broker, whatever. Pick up the phone. Let me know how I can help. I'm happy to help. And keep in mind that time kills all deals. So start now.
You're
Let's
right.
make it happen.
You're so right. Listen, I can 100% say she means it when she says pick up the phone and give her a call and reach out to her. And if there's anything that we can do here, of course, at Red Boot LLC, we'd love to potentially partner with you and see if we have, simpatico relationship that we can work together with Julie on the next deal. So go over to redbootllc.com, or if you're watching this on YouTube, go to the description, or if you're watching this from the website, listening to this from the podcast, look in the description. All that stuff should be there. Again, thank you so much, Julie, for your time.
Absolutely.
Talk to you soon.
Thank you. Talk to you soon.